Following Donald Trump's victory in the November 2024 election, newly released data from December 2024 regarding foreign holdings of US Treasury securities highlighted a significant retreat among major investors. Out of the 20 economies tracked, 16 scaled back their holdings. The most pronounced reductions came from the United Kingdom, which slashed its holdings by $44.1 billion, followed by Japan with a decrease of $27.3 billion and Saudi Arabia with a reduction of $15.1 billion. Other notable declines included China at $9.6 billion, Switzerland at $9.7 billion, and India at $14.9 billion. This pattern indicates that global investors and central banks remain cautious about the political and economic risks associated with the Trump administration. Historically, foreign governments and major institutional investors closely scrutinize U.S. policy signals, particularly regarding trade, monetary policies, and diplomatic relations. If these signals appear unpredictable or potentially contentious, nations often reduce their exposure to U.S. assets as a safeguard against volatility. In particular, uncertainty over U.S. government borrowing could intensify if key creditors anticipate policies that may weaken the dollar or expand the federal deficit, thereby making U.S. Treasury securities less appealing. A broad sell-off by foreign investors could push up yields on U.S. debt, raising borrowing costs for the U.S. Treasury, and, by extension, American consumers and businesses. Even a slight uptick in Treasury yields, if accompanied by expectations of tighter monetary policy, can influence mortgage rates, corporate bond markets, and the broader global financial system. Investors may interpret persistent sell-offs as an indication that confidence in the U.S. dollar as the world's dominant reserve currency is diminishing. While the dollar has retained its status for decades, a sustained decrease in foreign ownership of U.S. Treasuries could signal a gradual shift toward alternative assets, including euro-denominated bonds, other major currencies, or even gold. Beyond short-term market fluctuations, the post-election sell-off may hint at deeper geopolitical tensions. If the Trump administration's policies introduce new trade barriers or escalate bilateral conflicts, large foreign holders of U.S. Treasuries may continue diversifying their portfolios. Such moves do not require public declarations to have a tangible impact. Gradual reductions in U.S. debt exposure over time can subtly erode the dollar's position in global finance. If tensions escalate or policy unpredictability continues to drive uncertainty, December's sell-offs may foreshadow a prolonged and systematic shift away from reliance on U.S. financial markets. Central banks have traditionally held U.S. Treasuries as a secure means of maintaining foreign exchange reserves. However, there is a growing effort to diversify these reserves to mitigate dependency on the U.S. dollar. This strategy, often termed de-dollarization, involves increasing allocations to alternative assets, such as gold or non-dollar currencies. For instance, China has been gradually reducing its U.S. Treasury holdings, which stood at $760.1 billion as of October 2024, marking the lowest level since February 2009. This shift aligns with China's broader objective of diversifying its reserves and limiting its exposure to dollar-denominated assets. The dominant role of the U.S. dollar in global financial transactions grants the United States significant leverage over the international economy, including the power to impose financial sanctions. As a result, some countries have begun reassessing their reliance on dollar-based assets to shield themselves from potential economic coercion. Analysts on the Unhedged podcast have discussed how central banks and sovereign wealth funds are increasingly shifting from U.S. Treasuries to gold, partly to protect their reserves from possible U.S. sanctions. Nations such as Poland, Turkey, India, Iran, and China have been notable gold buyers in this context. Currency interventions and domestic economic policies also play a role in the sale of U.S. Treasuries. Some nations liquidate dollar assets to stabilize their domestic currencies. For example, Japan's Treasury holdings declined to $1.06 trillion in December 2024, down from $1.87 trillion the previous month. This reduction is partially linked to Japan's strategy of strengthening the yen by selling dollar assets and purchasing yen. Such interventions are aimed at maintaining currency stability, but often result in a decline in foreign reserves held in U.S. Treasuries. Expectations of rising Treasury yields, coupled with projections of higher economic growth and inflationary pressures from Trump administration policies, such as tariffs and immigration reforms, have contributed to these shifts. Higher yields reduce the market value of existing bonds, prompting investors to reassess their portfolios. Additionally, the Federal Reserve's indication of fewer interest rate cuts in 2025 due to inflation concerns has further influenced market trends. The global economic landscape has been gradually shifting since the September 11, 2001 attacks, during which the United States began leveraging the dollar as a tool of economic influence through financial sanctions and restrictions on access to the U.S. financial system. Countries such as Iran, North Korea, and Russia have been targeted by these measures, which, while effective in some cases, have also encouraged a global re-evaluation of dependence on the dollar, prompting several nations to explore alternatives. One significant strategy in reducing reliance on the dollar has been increasing trade conducted in local currencies. China and Russia, for instance, have expanded trade in yuan and rubles, while India and Iran have explored similar mechanisms to circumvent transactions involving the US dollar. Another major shift has been the development of alternative financial systems designed to bypass the traditional Western-dominated networks such as SWIFT. Russia has implemented the System for Transfer of Financial Messages, SPFS, while China introduced the Cross-Border Interbank Payment System, CIPS. These frameworks aim to provide participating nations with greater autonomy in financial transactions, reducing their vulnerability to U.S. sanctions. Before the U.S. dollar became the world's dominant reserve currency, the British pound sterling held that status. The pound's influence was deeply connected to the vast British Empire, whose expansive trade networks and financial infrastructure ensured the widespread use of sterling in international commerce. By the late 19th and early 20th centuries, the British pound stood as the world's dominant reserve currency. However, the financial burden of World War I significantly weakened Britain's economic position. The war effort resulted in massive national debt and a depletion of gold reserves, leading to diminished confidence in the pound. Efforts to restore the pre-war gold standard in 1925 proved short-lived, as the Great Depression further destabilized global markets. By 1931, speculative attacks forced Britain to abandon the gold standard entirely, intensifying instability in international monetary arrangements. During this period, the United States was steadily rising as a major economic force. The establishment of the Federal Reserve System in 1913 provided the country with a centralized banking authority, which bolstered financial stability. In the interwar years, New York grew into a financial hub that rivaled London, and the U.S. dollar began to gain traction as a preferred international currency. The aftermath of World War II further tilted the balance in favor of the United States. At the Bretton Woods Conference in 1944, the U.S. dollar was formally established as the world's primary reserve currency, backed by the largest gold reserves globally. This agreement positioned the dollar at the center of global finance, as many national currencies were pegged to it, with the dollar itself being convertible to gold. The Bretton Woods system, which was implemented in 1944, laid the groundwork for post-war international monetary relations. Under this arrangement, the U.S. dollar was fixed to gold at a rate of $35 per ounce, while other major currencies were tied to the dollar, forming a system of fixed exchange rates. However, by the late 1960s, mounting economic challenges, including inflation and a growing balance of payments deficit, began to strain this framework. In 1971, President Richard Nixon introduced a series of economic measures that effectively dismantled the Bretton Woods system, including suspending the dollar's convertibility into gold. This decision, often referred to as the Nixon shock, marked the transition to a system of floating exchange rates, fundamentally reshaping global finance. The era of the Bretton Woods system from 1944 to 1971 played a crucial role in shaping the post-war financial order. The conference, held in New Hampshire in July 1944, brought together representatives from 44 allied nations to devise a system that would promote economic stability and curb the competitive devaluations and protectionist policies that had contributed to economic turbulence in the interwar period. A key feature of the agreement was the establishment of a fixed exchange rate system, where the U.S. dollar was pegged to gold, and other currencies were linked to the dollar, making it the foundation of the international monetary system. To support this framework, two major institutions were created. The International Monetary Fund, IMF, was tasked with overseeing the system of fixed exchange rates centered around the U.S. dollar and gold, providing a platform for international monetary cooperation. Additionally, the International Bank for Reconstruction and Development, IBRD, now part of the World Bank Group, was established to facilitate financial and technical assistance for rebuilding war-torn Europe and promoting economic development in other regions. This system solidified the dollar's position as the leading global reserve currency. With the U.S. emerging from World War II As the strongest and least damaged of the major powers, global confidence in the dollar soared. By the 1950s and 1960s, central banks worldwide held significant reserves of US dollars, reinforcing its dominance. By the late 1960s, however, rising US deficits and escalating global demand for gold placed increasing strain on the Bretton Woods system. In 1971, President Nixon made the unprecedented move of suspending the dollar's convertibility into gold, a decision that became known as the Nixon shock. This effectively ended the gold standard and ushered in an era of floating exchange rates. Even without gold backing, the US dollar retained its global preeminence due to the strength of the American economy, the stability of US financial markets, and the widespread use of the dollar in international trade, particularly in oil transactions, a system commonly referred to as the petrodollar arrangement. Despite periods of volatility throughout the 1970s, the US dollar remained at the core of global trade and finance. Following the dissolution of the Soviet Union, the United States emerged as the world's sole superpower, marking a peak in dollar dominance. The 1990s witnessed a surge in globalization, with the U.S. leading in technological advancements, financial innovation, and capital market expansion. Key developments during this period included the continued role of U.S. Treasury bonds as the safest investment for global markets, the dollar's entrenched position in international trade, particularly in energy markets, and the introduction of the euro in 1999, which posed a limited but emerging challenge to the dollar's supremacy. By the early 2000s, the US dollar accounted for nearly 70% of global foreign exchange reserves, cementing its status as the world's primary currency. However, the financial crisis of 2008 marked the beginning of a gradual shift away from unchallenged dollar dominance. Several factors contributed to this transition. Since the crisis originated in the United States, its ripple effects were felt across the global financial system. Initially, investors sought refuge in US dollars and Treasury securities, reinforcing the dollar's role as a safe haven asset. However, the crisis also exposed critical vulnerabilities in the US financial structure, prompting central banks worldwide to reconsider their heavy reliance on dollar reserves. In the years following the crisis, many central banks diversified their portfolios by increasing their holdings in other currencies and alternative assets, such as gold. As a result, global central bank reserves of gold have steadily risen since the 2008 financial meltdown. China has played a pivotal role in challenging the dollar's dominance by advancing the internationalization of its currency, the yuan. The establishment of the Asian Infrastructure Investment Bank, AIIB, aimed to provide development financing across Asia, offering an alternative to Western-led institutions such as the World Bank. This approach not only bolstered China's economic influence, but also encouraged the wider use of the yuan in international transactions. Through initiatives such as the Belt and Road Initiative, BRI, China has financed large-scale infrastructure projects across multiple continents, many of which are structured in yuan, further integrating the currency into global trade. Additionally, China has pursued bilateral currency swap agreements with various countries, enabling trade and investment to bypass the US dollar, thereby reducing dependence on it. The rise of blockchain technology and digital currencies has introduced both challenges and opportunities to the traditional financial system. Many central banks have begun developing or piloting central bank digital currencies, CBDCs, to modernize payment systems and counter the growing influence of private cryptocurrencies. As of January 2024, approximately 130 countries, including the United States, were exploring the implementation of their own CBDCs. Leading this effort, China has introduced its digital yuan ECNY, which aims to enhance payment efficiency and elevate the yuan's international standing. The digital yuan could facilitate cross-border transactions, providing an alternative to a dollar-centric financial system. Meanwhile, the emergence of dollar-backed stablecoins has reinforced the US dollar's role in digital finance, while introducing new dynamics to the global monetary landscape. Stablecoins, often pegged to traditional assets like the US dollar, have become increasingly common in international transactions, potentially reinforcing the dollar's influence in the digital era. By 2022, the share of global foreign exchange reserves held in US dollars had declined to approximately 58%, while other currencies, such as the euro and the Chinese yuan, as well as gold reserves, gained traction. The reduction in US Treasury holdings by China has been an ongoing trend, not just in recent months but over several years, reflecting a broader global realignment of financial power. It now appears that other nations are taking note of the underlying motivations behind China's actions and are beginning to follow suit. China's holdings of US Treasury securities have been steadily declining. In 2013, China held approximately $1.3 trillion in US Treasuries, but by December 2024, the most recent available data shows that figure had dropped to around $759 billion. Several factors contribute to this reduction. Historically, China's significant trade surplus with the United States resulted in an accumulation of US dollars, which were then reinvested in US Treasuries, as a means of managing the renminbi exchange rate and maintaining export competitiveness. However, since 2018, as the trade imbalance between the two countries has narrowed, China's need to acquire treasuries to support its currency has naturally diminished. Additionally, Chinese policymakers have been increasingly advocating for a reduction in exposure to dollar-denominated assets within the nation's financial system. This approach is intended to mitigate risks associated with over-reliance on a single asset class and to seek better returns by diversifying investments. Furthermore, shifting geopolitical dynamics, particularly growing tensions between the United States and China, have prompted Beijing to reassess its holdings. Reducing U.S. debt exposure is seen as a strategy to minimize vulnerabilities linked to political conflicts. While some experts had speculated that a large sell-off could harm the U.S. by devaluing the dollar, others argue that it may actually strengthen the American economy rather than weaken it. It is also essential to recognize that while China's absolute holdings of U.S. Treasuries have declined, the overall size of the U.S. debt market has expanded. As a result, China's share of total outstanding U.S. Treasuries has fallen significantly. In 2011, China accounted for approximately 14% of all outstanding treasuries. By 2024, that percentage had dropped to less than 3%, marking the lowest level in 22 years. Japan, the largest foreign holder of U.S. Treasuries, has also seen a slight reduction in its holdings. Between March 2024 and December 2024, Japan's treasury holdings decreased from $1.167 trillion to $1.059 trillion. However, this decline is relatively modest and is largely attributed to Japan's ongoing efforts to stabilize the yen. As the Japanese yen has weakened considerably against the US dollar, the Bank of Japan has periodically sold US Treasuries to support its currency. Additionally, Japan's domestic fiscal policies, such as yield curve control and inflation targeting measures, have influenced its approach to reserve management. The United Kingdom's holdings of US Treasury securities also experienced a noticeable decline following Donald Trump's re-election in November 2024. Between March and December 2024, the UK's Treasury holdings fell from $768.8 billion to $722.6 billion. Several economic and geopolitical factors contributed to this shift. The Trump administration signaled plans for major tax cuts and increased government spending, leading to expectations of higher inflation and a growing fiscal deficit. These concerns triggered a rise in U.S. Treasury yields, which, due to the inverse relationship between bond yields and prices, caused the value of existing Treasury holdings to drop. This prompted investors, including the UK, to reevaluate and reduce their positions. The period following the 2024 election saw significant sell-offs in the global bond market, largely driven by concerns over inflation, anticipated shifts in U.S. economic policies, and strong economic indicators in the United States. Rising long-term borrowing costs for various governments, including the UK, influenced their decisions to decrease their exposure to U.S. Treasuries. Moreover, in response to escalating geopolitical uncertainties and the possibility of U.S. sanctions, several nations, including the UK, have sought to diversify their foreign exchange reserves. This diversification strategy involves decreasing reliance on U.S. dollar-denominated assets, such as treasuries, and increasing allocations toward alternative investments, including gold. Such measures are intended to mitigate risks associated with overdependence on a single currency or asset class. The appreciation of the U.S. dollar following the 2024 election, driven by expectations of pro-growth policies under the new administration, also played a role in these adjustments. A stronger dollar can impact the relative value of foreign-held assets, influencing decisions regarding the composition of national reserves. The UK's reduction in Treasury holdings may reflect a broader response to these currency valuation fluctuations. India has also trimmed its US Treasury holdings. Between March 2024 and December 2024, its holdings fell from $240 billion to $219 billion. This reduction aligns with the Reserve Bank of India's (RBI) foreign exchange management policies. The RBI has been actively intervening in currency markets to stabilize the Indian rupee, which has faced pressure due to global economic volatility, rising U.S. interest rates, and capital outflows. Additionally, India has been diversifying its foreign exchange reserves by increasing its gold holdings and exploring alternative asset allocations. This strategy is part of India's broader goal of reducing reliance on U.S. dollar-denominated assets while strengthening economic ties with emerging markets. Saudi Arabia has also cut back on its U.S. Treasury holdings, which declined from $142 billion to $137 billion over 6 months. As a major oil exporter, Saudi Arabia's foreign exchange reserves and treasury holdings are closely tied to fluctuations in global oil prices. The recent decline in reserves likely reflects a combination of lower oil revenues and strategic financial adjustments by the Saudi Arabian Monetary Authority. The kingdom's Vision 2030 initiative, which aims to diversify the economy and reduce dependence on oil revenues, has led to increased investments in domestic infrastructure, technology, and green energy. Additionally, Saudi Arabia's growing financial ties with China and other trade partners may have influenced its decision to reallocate reserves away from U.S. Treasuries. Germany has also seen a reduction in its treasury holdings, which fell from $114 billion to $97 billion within 6 months. As the largest economy in the Eurozone, Germany incorporates U.S. Treasuries into its foreign exchange reserves, which are managed by the Bundesbank. The slight decline in holdings may be attributed to shifts in Germany's reserve management strategies amid concerns over inflation and evolving monetary policies within the European Central Bank. Germany has also been increasing its investments in green bonds and diversifying its sovereign reserve portfolio to align with long-term economic sustainability goals. Additionally, this reduction could reflect broader efforts to strengthen the euro's role as an alternative reserve currency in global markets. Norway has similarly decreased its U.S. Treasury holdings, with a decline from $66 billion to $57 billion between August and December 2024. Norway's holdings are primarily managed through its sovereign wealth fund, the government pension fund Global, one of the world's largest sovereign wealth funds. Norway follows a diversified investment strategy, allocating significant capital to equities, fixed income securities, and alternative assets. The recent decline in U.S. Treasury holdings suggests a reallocation toward higher yield investments in response to shifting global interest rates. Norway's economic policies emphasize balancing risk while ensuring long-term financial stability, contributing to periodic adjustments in its treasury portfolio. The broader economic landscape remains highly uncertain, with newly implemented tariffs and escalating trade tensions adding further complexity. The introduction of reciprocal 25% tariffs on all nations, along with targeted tariffs on industries such as automobiles, semiconductors, and pharmaceuticals, has the potential to accelerate the sell-off of U.S. Treasuries. Beyond mere retaliation, countries affected by these tariffs may seek to reduce their exposure to U.S. debt as part of a broader strategy to limit economic dependence on the U.S. financial system. By selling off treasuries, nations can both counter trade restrictions and shift reserves toward alternative assets, further fueling the global trend toward de-dollarization. The current economic climate remains volatile, with trade conflicts between the United States and other major economies creating uncertainty. If these trade policies intensify, they could lead to financial market instability, disrupt global supply chains, and contribute to inflationary pressures. On the other hand, supporters argue that such measures may push for more equitable trade practices, potentially fostering a more balanced global economy in the long run. However, whether these policies will ultimately lead to stability or deepen economic fragmentation remains to be seen. Given the complexities of global trade and finance, the long-term impact of these tariffs is difficult to predict. The world may witness shifts in trade alliances, changes in reserve currencies, and a potential reconfiguration of financial markets. For now, close monitoring of these developments will be crucial in assessing whether they contribute to economic stability or drive the global economy toward greater uncertainty and disorder. That concludes today's discussion. We truly appreciate you watching. If you found this content insightful or thought-provoking, please consider showing your support by liking this video and subscribing to stay engaged with our community. Your participation means a lot to us. You can now check out another video from our channel, currently displayed on your screen.